Hey guys, welcome back to episode 207 of the Bitcoin Fortress podcast. Today is Sunday, March 15th, 2026. We are at block height 940,796, Moscow time 1398, and fees are a very manageable 1 sat per VByte for low, medium, and 2 for high priority. This week felt important, not because Bitcoin went vertical, but because it kept showing the market what it is. We had geopolitical stress, oil volatility, policy fights in Washington and abroad, more institutional flow into ETFs, more corporate accumulation, more Bitcoin native infrastructure getting funded, and more evidence that the next phase of adoption is going to be about actual utility, payments, privacy, custody, capital markets, and sovereign savings. So today we'll go through the news, starting with market structure, price action, policy and regulation, builders and infrastructure, and mining and corporate strategy. And then, of course, we'll swing through the Bitcoin podcast universe themes like we do every week. Feature this week's Bitcoin Fortress Substack post, Bitcoin versus compounding debt, and then we'll wrap it up. So with that, let's get into the news for March 8th through 15th. Starting with market structure, price action, and supply story. First up, Bitcoin quietly put together one of its strongest weeks in months. One of the biggest takeaways this week is that Bitcoin looks stronger than the vibes. By March 15th, CoinDesk noted Bitcoin was on pace for its best week since September 2025, and that its correlation with tech stocks had begun to weaken. At the same time, US spot Bitcoin ETFs posted a 5-day inflow streak during the week. Farside's daily data shows net inflows of 167.1 million on March 9th, 246.9 million on March 10th, 115.2 million on March 11th, 53.8 million on March 12th, and 180.4 million on March 13th. That is real demand, folks, not narrative fluff. This is the kind of week Bitcoiners should pay attention to, not because it's euphoric, but because it's constructive. If you can absorb macro stress, war headlines, and risk-off conditions while still pulling in ETF demand, that tells you Bitcoin is acting more like a maturing monetary asset and less like a pure speculative toy. Michael Saylor's strategy bought 17,994 Bitcoin for about $1.28 billion, bringing total holdings to 738,731 Bitcoin. Reports noted the average purchase price on this tranche was roughly $70,946 per coin, funded largely through common stock issuance and preferred equity. Whatever people think about the capital structure, the signal is clear. Saylor is still using volatility as an opportunity to accumulate. The bigger story is not just the buy. It's that strategy remains the prototype for the Bitcoin Treasury Company model, and every week they reinforce that the playbook is still issue capital, acquire scarcity. This week, Bitcoin passed a major symbolic threshold. 20 million Bitcoin have now been mined, meaning more than 95% of the full 21 million supply is already in circulation. Multiple reports noted that the final million coins will be issued gradually over roughly the next century through the halving schedule into the 2140 era. This milestone matters because it sharpens the contrast with fiat. Central banks can create trillions with a policy announcement. Bitcoin just crossed 20 million after more than 17 years of transparent issuance, and the remaining supply will come out at a glacial pace. Scarcity is not a slogan here, it is literally enforced by the network. Investors Business Daily reported nearly $587 million of spot Bitcoin ETF inflows for the week ended March 13th, while another report put the total closer to 767 million, depending on the data set cut and timing. The important point is direction. After a weak February, ETF demand has turned back positive in March. This is the kind of divergence I like to watch. When legacy markets are stressed but Bitcoin flows are improving, it suggests the buyer base is widening. It also suggests institutions are increasingly willing to treat Bitcoin pullbacks as allocation opportunities rather than reasons to flee. CoinDesk highlighted research suggesting that only about 8 to 10% of global Bitcoin hash rate is exposed to oil-sensitive power markets, meaning geopolitical oil spikes are more likely to affect mining indirectly through Bitcoin price sentiment than through immediate network stress. That's a great reminder that the Bitcoin network is globally diversified. The lazy headline is "Oil up, miners doomed." The more intelligent take is that Bitcoin mining is geographically and energetically more distributed than critics assume. Yes, energy markets matter, but the network is not hanging by a single pipeline. All right, moving right along into policy regulation and the political battlefield. The SEC and CFTC announced a memorandum of understanding on March 12th to coordinate on crypto and other emerging technologies. The agencies said the agreement is meant to support lawful innovation, market integrity, and clearer coordination rather than overlapping turf wars. This does not magically fix U.S. crypto regulation, but it does matter. For years, one of the biggest problems in the U.S. has been regulator on regulator confusion. If this reduces contradictory enforcement and gives market participants clearer lanes, that's constructive. It is especially important for Bitcoin financial products, custodians, and derivatives infrastructure. The stablecoin yield debate remained a major pressure point this week. Reuters previously reported the broader U.S. crypto bill process had stalled over whether stablecoin issuers or related firms could offer yield-like rewards. And CoinDesk highlighted Rick Edelman, arguing crypto should not, quote, die on the hill of stablecoin yield. A new Congressional Research Service brief also laid out the policy issue in plain terms. Why should Bitcoiners care? Because the stablecoin fight is now one of the main choke points for broader U.S. digital asset legislation. Even when Bitcoin itself is not the target, the whole sector's policy momentum can get delayed by fights over bank deposit competition and dollar token incentives. This is one more reminder that Bitcoin benefits from being simpler than the rest of the industry. A very Bitcoiner story this week. Reports and commentary claimed Coinbase lobbyists were pushing lawmakers toward a stablecoin only de minimis exemption rather than the one that also clearly covers Bitcoin. DL News summarized the controversy, while Marty Bent published a sharply worded report claiming multiple sources confirmed that push. Coinbase executives publicly denied the allegation. Whether every detail is right or not, the controversy exposed a real fault line. Do policymakers want Bitcoin treated as money for small everyday payments? Or do they want to shove it into a digital gold only box while reserving transactional preference for compliant dollar stablecoins? That fight matters. A true Bitcoin de minimis exemption would make Lightning and small commerce much more usable in the United States. So stay tuned on that one. Reuters reported that Bank of England Deputy Governor Sarah Breeden said that the BOE is open to revisiting its proposed stablecoin regime, including controversial rules that would require a large share of backing assets to sit as unremunerated central bank deposits and would cap holdings for individuals and businesses. This is also not a Bitcoin headline on its face, but it's important context. Around the world, regulators are still trying to decide whether stablecoins are banking products, payment rails, or something in between. Every time these rules get contested, Bitcoin's clean monetary identity looks stronger by comparison. Bitcoin doesn't need a central bank balance sheet to justify its existence. The aftershocks from Kraken securing a Federal Reserve master account continued to ripple through the Bitcoin space. CoinDesk reported Kraken became the first crypto native company to gain direct access to the Fed's payment systems through its banking arm. And follow-on analysis suggested this could open the door to more firms getting limited access in the future. This is a huge institutional infrastructure story. It doesn't mean Bitcoin wins overnight, but it does mean one more wall between crypto native firms and the core dollar plumbing just got breached. Direct access to payment rails matters if the US is serious about integrating Bitcoin and digital asset infrastructure into mainstream finance. Next, let's move on to builders, payments, custody, and Bitcoin native infrastructure. Lots of good stuff to report this week, starting with MasterCard, who announced the new crypto partner program, bringing together more than 85 companies to collaborate on digital asset and payment products. MasterCard said the goal is to combine the speed and programmability of digital assets with established card rails and global commerce flows. From a Bitcoiner perspective, this is both bullish and cautionary. Bullish because it shows the legacy payments giants know on-chain settlement is not going away. Cautionary because their instinct will be to absorb the tech without giving up control. So the question is, does this expand freedom or just create a shinier surveillance finance stack? Bitcoiners should watch that closely. Tether announced a strategic investment in Arc Labs, part of a $5.2 million funding round to expand stablecoin access and programmable financial infrastructure on Bitcoin. Arc Labs said the round brought total institutional backing to $7.7 million. This is one of the most interesting builder stories of the week. Forget the noise for a second. Serious capital is now backing efforts to make Bitcoin a stronger settlement and financial infrastructure layer, not just a vault asset. Whether every approach succeeds is another question, but the direction is obvious. More teams are trying to build payment and stablecoin functionality around Bitcoin's gravity. Metaplanet disclosed on March 12th that it is establishing Metaplanet Ventures KK and a new U.S. subsidiary called Metaplanet Asset Management. Reporting around the announcement said the venture arm plans to invest about 4 billion yen over the next few years into Bitcoin-related infrastructure in Japan. That is a meaningful evolution. First wave, buy Bitcoin for the treasury. Second wave, build around the treasury. Metaplanet seems to be moving from Bitcoin holder to Bitcoin platform company. That is exactly the kind of shift you would expect as Bitcoin matures from asset to ecosystem. CoinKite introduced the new Cold Card MK5, continuing its Bitcoin-only hardware wallet line. Coverage described it as the next generation of the air-gapped device, and promotional material highlighted improved usability while staying aligned with the firm's security-first, Bitcoin-only approach. This matters because self-custody remains one of the core dividing lines in Bitcoin. ETFs, treasury companies, and fintech integrations can grow all they want, but if the tools for serious self-custody keep improving, Bitcoin's decentralizing force remains intact. Every better hardware wallet is another brick in the sovereignty wall. Reports out of France described a home invasion in which a couple was forced at knife point to transfer roughly 900,000 euros worth of Bitcoin. Authorities are reportedly worried about a growing pattern of crypto-linked robberies and home invasions. This is the dark side of self-custody that people don't like to discuss. OPSEC matters, privacy matters, not flaunting holdings matters. The future of Bitcoin is not just multi-sig and hardware wallets, it's also discretion, good physical security, and not making yourself an obvious target. Moving right along to mining, energy, and corporate strategy. First up on the Blockspace pod, TerraWolf CTO Nazar Khan discussed the company's expansion into AI and HPC, including sites in Kentucky and Maryland, and how TeraWulf plans its Bitcoin mining fleet alongside that build-out. This is the mining story of 2026. Can you use the same energy and site development skills set for both Bitcoin and compute? The miners that survive may be the ones that can flex between energy markets, Bitcoin mining economics, and AI-style data center demand without losing discipline. Also on the Blockspace pod, the episode titled The Last Bitcoin Mining Bull Market Ever framed Canaan as a miner and manufacturer that is doubling down on Bitcoin while others pivot toward AI. I like having both stories on the board at once. One camp is saying mining must diversify into AI to defend margins. The other is saying there's still serious room for conviction in pure Bitcoin infrastructure. That tension is healthy. It means the market is still figuring out whether mining is best treated as an energy business, a compute business, or a monetary infrastructure business. All right, moving on to Bitcoin podcast universe themes. This week's podcast universe felt unusually coherent. A few big themes kept repeating across shows. And so theme one, Bitcoin is separating from the old risk asset only framing. What Bitcoin did on March 10th featured Luke Gromen in Iran, Oil, and the Next Financial Crisis. I actually listened to this one in its entirety and highly recommend you check it out. Luke is a smart dude. Clearly tying Bitcoin into macro stress, oil shocks, and systemic fragility. Meanwhile, Simply Bitcoin spent the week hammering related themes in episodes like Will the US Freeze Your Money Next? They're buying while you're panicking, and the government has no choice. Trillions must be ... The common thread was simple. In a world of debt, war, and monetary disorder, Bitcoin keeps making more sense. The macro Bitcoin conversation is maturing. It's less number go up because money printer, and more what asset do you want when the entire financial architecture looks fragile and improvisational. That is a much more serious conversation. Frankly, that's kind of where my head's been lately as well. Theme two, Bitcoin payments and privacy are back at center stage. This was a huge week for Bitcoin payments discourse. Stefan Livera podcast 728 featured Callie discussing NumoPay, an open source tap to pay Bitcoin terminal using NFC, QR, and privacy preserving eCash rails. On TFTC 723, Marty Bent and Matt Corallo argued that AI agents and internet native payments create a time sensitive opportunity for Bitcoin to become the web's payment rail. For a while, the market was fixated almost entirely on ETFs, treasuries, and price. This week, the podcast world reminded everyone that Bitcoin's endgame is not just institutional storage, it's native digital money, private, programmable enough, and usable in the real world. Theme three, the cycle debate is not over. Is the four-year cycle broken conversation stayed alive? The Bitcoin podcast featuring Rational Root, arguing this cycle feels different because ETF flows and institutional adoption created a more distributed top instead of a classic blow-off. At the same time, what Bitcoin did had Matthew Mazinkas the prior week on the four-year cycle is not broken. My read is that both camps may be partly right. The old cycle rhythm may still exist, but the plumbing has changed. ETFs, treasury companies, OTC flows, and a more institutionally fragmented market probably dampen the old retail mania pattern, so maybe the cycle isn't dead, maybe it's just maturing. Theme four, open source infrastructure still matters more than the headlines. Rabbit Hole Recap 399 touched a broad sovereignty stack, the U.S. Marshals theft story, Strike expanding in New York with a line of credit product, Graphene OS partnering with Motorola, and Bitwise donating to open source developers. Stefan Livera Podcast 730 went deep on cluster mempool with Peter Woolley, reminding listeners that under the hood, Bitcoin's technical evolution keeps moving. Bitcoin is not just price policy and public companies, it's also the slow grind of developer work, wallet improvements, privacy tools, mempool design, mobile hardware, and open source funding. That layer is what gives the whole thing durability. And finally, theme 5, mining is being forced to define itself. So between the Blockspace Pod episode on TeraWolf's AI expansion and the one on Canaan doubling down on mining, you can hear the industry wrestling with identity. Is mining a Bitcoin business that opportunistically leases compute, or is it an energy data center business that happens to mine Bitcoin? That debate is not bearish. It's what happens when an industry grows up. Next, I did want to mention this week's featured Substack post, Bitcoin versus compounding debt. If you enjoyed today's episode, go read this week's featured post on the Bitcoin Fortress, Bitcoin versus compounding debt. The core idea is that the fiat system runs on compounding obligations. Household debt, corporate debt, sovereign debt, rollover debt, interest expense on interest expense, while Bitcoin offers an exit into an asset that does not depend on someone else's liability stack. It's an asset without an issuer. It's one of the cleanest ways to explain why Bitcoin is not just an investment, it's a completely different foundation. And of course, don't forget the 3 Bitcoin Fortress books, links in the show notes to those, as well as all the articles that we covered this week. If you want a straightforward, signal-heavy way to deepen your understanding of Bitcoin, please check them out. They're designed for real people trying to make sense of money, sovereignty, and self-custody, and the long game without the fluff. Okay, that is a wrap for episode 207 of the Bitcoin Fortress podcast. This week's message is rather simple. Bitcoin kept doing Bitcoin things. The supply got scarcer. The institutions kept buying, the builders kept building, the regulators kept scrambling to catch up, and in a world still drowning in debt, conflict, fragility, and financial theater, Bitcoin kept offering the same thing it always has, a rule-based alternative. Stay humble, stack sats, build your fortress, and I will see y'all next week. Bye-bye.